Right now, the average new car in America costs $50,000. That is not a typo. By the end of 2025, the average transaction price for a new vehicle hit $50,326 according to Kelley Blue Book, and that number is not being driven up by exotics or luxury brands. It is being driven up by pickup trucks and full-size SUVs that millions of ordinary Americans are buying every single month. So the question every sensible buyer is asking right now is simple. If new cars cost that much, does it actually make more financial sense to buy used? Or are there hidden costs in the used market that make new cars worth the premium? Today we are going to run the actual numbers, look at where the market really stands, and help you figure out which decision keeps more money in your pocket and which one quietly drains your bank account for years without you realizing it. Before we get into the comparison, you need to understand the market you are actually walking into in 2025. New car prices are sitting near all-time highs. The average transaction price, meaning what people are actually paying, not what the sticker says, was $49,353 in February 2026, which is 3.4% higher than a year earlier. That is far above the typical monthly gain of about 0.9%. Strip out the full-size pickups, and the average falls to around $39,000. Compact SUVs, which are the best-selling segment in America, average $36,800. Now, the used side, the average used car listing price in 2025 sat at around $25,600. But that number hides something important. If you are shopping specifically for a used car that is under 8 years old, which most buyers are, the average price climbs to $30,200, according to GD Power data. And if you want something under $20,000, the inventory is genuinely thin. Back in 2019, over half of all used cars on the market were priced below $20,000. By 2025, that had fallen to just 30%. The affordable end of the used market has been hollowed out, and buyers are feeling it. Most people approach a car purchase with one goal: keep the monthly payment as low as possible. That is the wrong goal, and the math is going to show you exactly why. But first, let us understand what each side is actually promising you. Buyers who go new want certainty. A full factory warranty, no previous owners, the latest safety features, and a car that has never been in an accident. They are willing to pay more for that clean slate. Buyers who go used want savings. They assume they can get essentially the same car for meaningfully less money. In theory, they are right. In practice, the gap between the purchase price and the actual total cost of ownership is where most buyers get blindsided. Here is the single most important number in this entire conversation: 20%. That is how much value a brand new car loses in its first year of ownership, according to Kelley Blue Book. On a $50,000 vehicle, that is $10,000 gone in 12 months, not from an accident, not from neglect, simply from ownership. Over the first 2 years, the average new car loses 30% of its value. Over 5 years, it loses somewhere between 55 and 60%. Do the math on a $50,000 car. After year 1, it is worth roughly $40,000. After 2 years, around $35,000. After 5 years, somewhere in the range of $22,000. You paid $50,000. You lost approximately $28,000 in depreciation alone over 5 years. That works out to roughly $560 per month before you have paid a single dollar in insurance, fuel, or maintenance. This is the core argument for buying used. When you purchase a 2 to 3-year-old vehicle, the previous owner has already absorbed that brutal first depreciation hit. You are buying in after the steepest drop in value, and you still have most of the car's useful life ahead of you. Industry analysis using IC-Cars 2025 data consistently identifies 2 to 3 years old as the sweet spot. Enough depreciation has happened to make the price meaningfully lower, but the vehicle is still recent enough to be reliable and often still under parts of the original manufacturer warranty. Now here is where new cars fight back and where the used market has its own hidden cost that a lot of buyers miss entirely. New car loans on average carried an interest rate of 6.37% in Q for 2025, according to Experian. Used car loans averaged 11.26%, nearly double. Lenders charge more to finance used cars because they represent higher risk collateral. The vehicle is older, harder to value, Precisely, and may have unknown history. That rate difference shows up dramatically when you run actual numbers. Say you are buying a new car at $50,000. You put down $5,000 and finance $45,000 at 6.8% over 60 months. Your monthly payment is around $887 and you pay approximately $8,000 in interest over the life of the loan. Now take a used car at $26,000. You put down $3,000 and finance $23,000 at 11.26% over 60 months. Your monthly payment drops to about $500, but your total interest paid is still close to $7,000. Your loan is nearly half the size, your rate is almost double, and you end up paying almost the same total interest. The monthly payment is lower on the used car, yes, but the real savings come from the lower principal and the depreciation you avoided, not from some magic deal on interest. According to Edmunds data from Q for 2025, the average monthly payment on a new car was $772 with an average down payment of $6,228. For a used car, the average payment was $570 with a down payment of $3,956. That $200 monthly difference sounds manageable. Across a 5-year loan, it adds up to $12,000. Add in the typically higher insurance premium on a new vehicle, and the gap widens further. Used car insurance is generally cheaper because the vehicle's replacement value is lower. On the maintenance side, new cars under warranty have a real advantage most issues in. The first 3 to 5 years are covered. A used car outside of warranty means every repair comes out of your pocket. The used market is not without its own risks, and you need to go in with your eyes open. The supply of clean, affordable used inventory is tighter than it looks. Leasing activity hit its low point in 2022, which means fewer quality 3-year-old certified pre-owned vehicles are flowing back into the market in 2024 and 2025. This is keeping prices elevated on the best used options. The cheap end of the market, cars under $20,000, is particularly thin. Hidden damage is a real issue. Not every seller discloses accident history, and not every repair job gets properly documented. Before you buy any used car, run a Carfax or AutoCheck report on the vehicle identification number. These cost between $10 and $45 and can reveal accidents, flood damage, salvage titles, and odometer fraud that would otherwise cost you thousands down the road. The high interest rate environment on used car loans hits buyers with lower credit scores especially hard. If your credit score is below 600, your used car loan rate could be anywhere from 16 to over 20%. At those rates, financing a $25,000 used car can end up costing you $35,000 or more by the time the loan is fully paid off. That changes the value equation significantly. So who should genuinely consider buying new? You should look seriously at a new car if you have strong credit, generally above 740, and can qualify for manufacturer incentive rates. Several brands periodically offer 0% APR on specific models, and at 0%, you are only paying for the vehicle's depreciation, which you can manage by choosing a model that holds its value well. Toyota, Mazda, and select Honda models are among the brands that consistently show lower 5-year depreciation than the industry average. You should also consider new if you plan to keep the vehicle for 8 or more years. The longer you hold it, the more the depreciation cost spreads across your years of ownership and the less it hurts on a per-year basis. The warranty value over the first 3 to 5 years becomes real money saved on avoided repairs. And if you are buying a new vehicle assembled in the United States, the auto loan interest deduction that took effect under the law signed in July 2025 allows you to deduct up to $10,000 per year in loan interest for tax years 2025 through 2028. That is a meaningful benefit for buyers in higher tax brackets who would otherwise be leaving money on the table. Now, who should lean toward used? The honest answer is most buyers. If your budget makes new car options feel like a stretch, they probably are a stretch. If keeping your monthly payment under $500 is a real requirement for your household budget, a new car at current average prices is nearly impossible without stretching your loan term out to 84 months, and that creates serious negative equity risk. When a $50,000 car depreciates to $35,000 over 2 years while you still owe $42,000 on the loan, you are trapped. You cannot trade it, you cannot sell it without bringing cash to the table, and any major accident that totals the vehicle will leave you with an insurance payout that does not cover what you owe. A 2 to 3-year-old used vehicle from a reliable brand gives you most of the same driving experience at a dramatically lower cost. You sidestep the worst depreciation, you carry a smaller loan, and if you buy smart, you still have years of useful life ahead with minimal surprises. Here is the practical guidance that will actually help you. For used car buyers, focus on vehicles that are 2 to 3 years old from brands with strong reliability track records. Toyota, Honda, Mazda, and Subaru consistently top independent reliability surveys, and their used vehicles hold value without being overpriced. Look at certified pre-owned programs. These include a manufacturer inspection, address open recalls, and typically extend limited warranty coverage. Always get the vehicle's VIN history report before agreeing to purchase, and for any vehicle priced above $30,000, pay for an independent pre-purchase inspection from a mechanic you trust. Do not let anyone pressure you past that step. For new car buyers, avoid the vehicle categories with the worst depreciation history. Electric vehicles from brands without strong residual values, European luxury sedans, and domestic minivans are among the categories that consistently show steep 5-year depreciation well above the market average. Focus on vehicles where the resale value is proven. Compact SUVs and pickup trucks from Toyota, Honda, and Ford have historically held their value far better than the industry average. That means your total cost of ownership is actually lower even if you paid more upfront. For both, get your financing arranged before you walk into the dealership. Get pre-approved through a credit union or online lender. Dealership arranged financing is convenient but often carries rates above what you can find elsewhere. Knowing your rate and your maximum loan amount before you negotiate the price gives you leverage and removes one of the dealer's main tools for extracting extra profit. The monthly payment conversation is where dealers make margin. Keep the focus on the total out-of-pocket cost, not the monthly number. So which one actually saves more money in 2025? For the majority of American buyers, a 2 to 3-year-old used vehicle from a reliable brand is the stronger financial decision. You avoid $10,000 to $15,000 in first-year and second-year depreciation. You carry a smaller loan balance, and with careful buying, you get a vehicle with most of its useful life still ahead. That said, the answer is not the same for everyone. If you have strong credit, qualify for 0% manufacturer financing, and plan to keep the car for 8 or more years, a new car can be cost competitive on a total cost basis when you account for warranty savings, the interest tax deduction, and avoided early maintenance costs. A well-maintained new Toyota compact SUV held for 10 years is not a financial disaster. A poorly chosen used car with hidden flood damage bought at an 11% interest rate absolutely can be. The worst financial move in this market is making either decision without understanding the full picture. The sticker price is the beginning of the conversation, not the end of it. Depreciation, financing, insurance, and maintenance are the 4 forces that decide what a car actually costs you. Calculate those numbers before you sign anything, and never let a sales process rush you past that math. Know your numbers, own the deal.